Hey guys, it's Cameron here with Emerson Property Management. Every week I bring you tools, tactics, strategies, lessons I've learned, things that have helped me build up a sizable rent portfolio in about 2 years and now manage that portfolio. Today I want to take a question from Dan. Dan is a good friend of mine. He asked how the IRS classifies someone as a real estate professional. So how's the IRS classify you as that? And then I'm going to talk about why you would ever want to be classified as a real estate professional, because it can be very lucrative. So basically there are two criteria. You have to, one, spend half of your activity on real estate related things, or half of your time on real estate related activities. Have half of your business activities related to real estate. So you could be a realtor, you could be a property manager, you could be an investor, you could be a flipper, a buy and hold, whatever. And the second piece, I want to make sure I get the hours right, is you have to perform more than 750 hours in the related real estate activities. So what does that mean? You have to log 750 hours. There's about 2,080 work hours in a standard year. That's 40 hours a week with 2 weeks of paid holiday or whatever. Or maybe it's 2,000. It's 2,080. It's right around 2,100, a little less than 2,100. So that says you need to spend just about half of your logged hours on that activity. What that means is you need to have businesses related to real estate, and then you need to spend a lot of time on those businesses to be able to qualify as a real estate professional. Now, why would you ever want to qualify as a real estate professional? The main reason is currently in 2020, you're only allowed to write off $25,000 in passive losses, passive real estate losses. Meaning, you go do a flip, you lose $100,000 because you weren't paying attention or whatever. You can only write off $25,000 a year for the next 4 years. Now, I guess flips would be a bad example because that's a more active activity. Let's use rentals for an example. You lose $100,000 and you have a rental portfolio, and due to depreciation and all your tax write-offs, you lose $100,000 that year. You can only write off $25,000 a year for 4 years. If you qualify as a real estate professional, you can accelerate that and write off all $100,000 in year one. And then the next year, if you lose $50,000, you can write off $50,000. So your passive losses, whether you want to classify as a real estate professional or not, really depends on whether you want to be an active real estate professional, actively investing, or you want to treat it as a passive activity. Now, if you're treating it as passive, where you just invest in rentals and don't want to mess with anything, then you're going to be capped at $25,000 in losses. Now, I'll tell you, it's not that hard to lose $25,000 on a handful of rental properties. Now, in general, but I'm talking even on paper, because you have the depreciation schedule. So depreciation, take out the land, it's your property minus the land value divided by 27 and a half years. You can do fancy cost segregation studies, but that depreciation really helps you. Even though you might actually make money, it'll help you show a loss on paper on your tax return. And let's just say you lose $2,000, $3,000, $4,000. You've got 5 or 10 properties. You got 10 properties. You lose $4,000. That's $40,000 you can write off against your, like say you still have a W-2. You can write off $40,000 against your taxes or against your normal W-2 job. So the government says, no. You guys aren't going to be able to do that. We're not going to allow these dirty scumbag investors to write off $40,000 in 1 year. So what do? They cap it at 25, and they say, if you want to write off all $40,000 in year one, you need to be an active investor, an active real estate investor, i.e. a real estate professional, where you have a lot of business. So I am a property manager, so I have my property management activity. And then I also own rentals, so I have my rental activity. So I will qualify, if I want to, as a real estate professional, where I can write off more than $25,000 in losses. Sometimes it makes sense to do it. You don't have to take the designation. You can claim it and not claim it. There's various bits and pieces of nuances on, like I said, on taxes. You got to make sure you file it on your taxes on your forms. But in reality, that is the thing. 750 hours, and do you have half of your time in real estate related activity. Those are the two big ones. And then it's really just, are you going to have, if you have one or two properties, it's not worth it. I mean, if you're losing $25,000 a year on one or two properties, that would be pretty extensive. Not saying you can't do that, but if you put in you spend $15,000 on a new roof on two properties or whatever, and you want to take that out a couple years, depreciate it over a couple years, then it kind of makes your taxes look great over time. So you really need to do the analysis and say, do I want to write all these off in year one? Do I want to wait? How do I want to do that? And that's when a good, solid CPA comes in. I believe I have another video over here on the benefits of using a CPA and just making sure that you're using a real estate professional and all the tax advantages that you guys can get by using real estate. So, Dan, I hope that answered your question. If it did, let me know. If it didn't, I don't know what to tell you because those are the answers. So I will try to link to one of the IRS publications or something. I'll link to one of the websites in here so you guys can view that, make sure I'm not full of BS. But that's pretty much it, guys. Determine that, do your analysis, get a great accountant and tax team, and they'll help you with that. Hope you guys enjoyed it. See you guys next week. Thank you.